Every cycle, the crypto industry celebrates the arrival of a new wave of venture-backed tokens as proof that institutional capital is finally validating the decentralized economy. Retail participants are told that these professionally funded projects represent the safest, most vetted opportunities in the market, backed by the same firms that built the winners of the previous cycle. But when you examine the actual tokenomics, the vesting architectures, and the coordinated exit infrastructure surrounding these launches, well, a devastating and deliberately obscured reality emerges. The entire token launch ecosystem is structurally engineered to manufacture just enough retail demand for insiders to exit their positions before the mathematical certainty of dilution destroys the price. And the data proves it. Nearly 85% of major token launches in the current cycle are already trading below their opening valuations, with a median drawdown exceeding 70%. My name is Lewis, and you're watching the Coin Bureau. Now, to understand why this pattern repeats with such brutal consistency, we need to examine the foundational mechanics that make the entire extraction cycle possible, and that is the low-float, high fully diluted valuation launch model. When a venture-backed token reaches its token generation event, commonly referred to as a TGE, only a tiny fraction of the total supply is made available for public trading. According to data published by Binance Research, the average market cap to fully diluted valuation ratio for tokens launched in 2024 was just 12.3%. This means that for every dollar of visible market cap at launch, approximately $8 worth of additional tokens remained locked behind vesting schedules, waiting to enter circulation. Put simply, the token you see trading on an exchange represents roughly 1/8 of the actual supply that will eventually compete for the same pool of buyer demand. This structure is not accidental, and it is not designed to protect early investors from volatility. By keeping the circulating float between 5% and 15% of total supply, projects can engineer extraordinarily thin order books where even modest amounts of buying pressure creates dramatic price appreciation. A token with $1 billion fully diluted valuation might only require a few $1,000,000 in actual liquidity to maintain that optical price level, because the vast majority of supply simply does not exist on the open market yet. The reality is that this creates an artificial scarcity premium that inflates the perceived value of the token during the exact window when retail participants are most aggressively entering positions. Furthermore, the downstream implications of this structure are mathematically devastating. That same Binance Research analysis estimated that approximately $80 billion in new demand-side liquidity would be required just to maintain launch day price levels as the remaining 87% of supply gradually unlocks over subsequent years. When you set that figure against an estimated $155 billion in total scheduled token unlocks projected between 2024 and 2030, well, the structural impossibility of sustaining these valuations becomes undeniable. There is simply not enough retail capital entering the altcoin market to absorb the relentless tide of insider supply hitting the order books month after month. You might assume that this supply pressure would be gradual enough for the market to absorb without catastrophic consequences, that informed buyers would simply price in the dilution and adjust their positions accordingly. However, that assumption completely ignores the coordinated demand manufacturing apparatus that surrounds every major token launch. You see, the period between a token's TGE and its first major vesting unlock is not a passive waiting game for insiders. It is an intensely orchestrated campaign designed to build the maximum possible retail demand precisely when it is needed most. Agencies coordinate multi-channel promotional blitzes across X, Telegram, and Discord, synchronizing influencer campaigns with exchange listing announcements and paid advertising to create a controlled momentum window. Influencers themselves are frequently compensated with project tokens subject to their own vesting schedules, which means their financial incentive to promote the asset is explicitly aligned with the period before their personal allocations unlock. Industry data from crypto marketing agencies report average conversion rates for influencer campaigns at approximately 6.5%, which is significantly higher than traditional digital advertising, explaining why KOL spending remains absolutely central to every major launch strategy. But the promotional infrastructure extends far beyond social media personalities. Market-making firms like Wintermute, DWF Labs, GSR, and Cumberland receive token loans from projects as part of their engagement arrangements, using those loaned tokens to provide artificial depth on exchange order books. This creates the visual appearance of organic buying pressure and healthy liquidity on trading platforms, even when the underlying demand is almost entirely manufactured. The scale of this artificial activity is honestly staggering. Academic research estimates that wash trading accounts for 50% or over 50% of reported volume on major exchanges and exceeds 80% on smaller platforms. A Binance internal investigation reportedly identified more than $300 million in suspicious wash trades linked to a single market-making firm across multiple tokens. This means that when a retail investor examines the trading volume of a newly launched token, concludes that strong organic demand exists, well, they are frequently looking at a manufactured illusion designed specifically to provide that false confidence. And this manufactured demand window is timed with surgical precision to coincide with the most dangerous structural event in any token's lifecycle, which is, of course, the vesting cliff. Standard vesting schedules impose a cliff period, typically 12 months, during which no insider tokens are released. After the cliff expires, tokens begin unlocking on a linear schedule, daily, monthly, or quarterly, for an additional 2 to 4 years. The critical design flaw embedded in nearly every vesting structure is that unlock schedules are tied exclusively to the passage of time, not to whether the project has achieved any developmental milestones, demonstrated genuine utility, or even attracted real user adoption. This completely decouples insider liquidity from actual project success. The consequences of poorly designed unlock events are visible across the entire market. December 2025 represented one of the most significant single months for unlock activity on record, with total scheduled releases exceeding $1 billion across projects, including things like Sui, Aptos, and Say. Now, consider the World Liberty Financial Token as a case study in how these mechanics compound. WLFI initially launched as a non-transferable asset in October of 2024, raising $550 million from investors who could not sell their positions. When the token finally became tradable in September of 2025, it launched with a fully diluted valuation approaching $3 billion, while the vast majority of supply remained locked. When WLFI subsequently proposed unlocking 16 billion tokens, the market responded by erasing $427 million in capitalization in a single trading day from dilution fear alone. The token has lost approximately 75% of its value since becoming tradable. Furthermore, on-chain analysis revealed that WLFI's treasury deposited $5 billion of its own governance tokens into a lending protocol co-founded by a project advisor to borrow $75 million in stablecoins, creating a circular financial arrangement where the project's own illiquid token served as collateral to extract real dollars. The Mantra collapse provides an even more dramatic illustration of what happens when concentrated supply meets a vesting event. Up to 90% of OM supply was held by the team and early investors, supporting a $6 billion market cap with a mere $4 million in total value locked, a ratio of 1,500 to 1. On-chain analysts at Look On-Chain identified 17 wallets depositing 43.6 million tokens to exchanges in the single week before the crash. The token dropped from approximately $6.30 to below 50 cents within hours, erasing over $5.5 billion in market capitalization. But even these visible collapses represent only the most obvious layer of insider extraction, because the most sophisticated VCs never hit the open market at all. A robust secondary OTC market allows insiders holding locked tokens to monetize their positions months or even years before official unlock dates. Firms including Cumberland, Galaxy Digital, and Coinbase Prime facilitate these off-exchange private transactions, typically at discounts of 20% to 50% below the prevailing market price. Because OTC trades occur entirely outside public order books, they produce no visible sell wall, no exchange inflow alert, and no whale tracker notification. An insider can offload tens of millions of dollars in token value without generating a single data point that retail monitoring tools would flag. And even when VCs cannot sell locked tokens through OTC channels, they can neutralize their market exposure by opening short positions in perpetual futures markets for the same asset. This effectively transforms what appears to be a committed long-term investment position into a hedge, near guaranteed return regardless of future price action. The VC has already locked in their profit, while retail buyers, looking at the vesting schedule, believe the insider is fully exposed to downside risk. Analysts have explicitly noted that this strategy transforms risky venture bets into liquid deals with near guaranteed returns, transferring all remaining market risk directly onto the retail participants who purchased at inflated prices. And when insiders eventually do sell on-chain, the infrastructure for concealment is remarkably sophisticated. Wallet fragmentation breaks large holdings into hundreds of smaller addresses to avoid whale alert monitoring thresholds. Cross-chain bridges route tokens through different blockchain ecosystems to break forensic trails. Privacy mixers sever the link between original insider wallets and eventual exchange deposits. The M3M3 token case involved over 150 separate wallets coordinating to create the appearance of organic distributed selling. This brings us to the fundamental question that separates aggressive tokenomics from outright criminal conduct. And in October 2024, the FBI provided the definitive answer by launching Operation Token Mirrors, an undercover sting using a bureau-created token called Next Fund AI to infiltrate the market manipulation service industry. The operation recorded executives from firms including Gotbit, CLS Global, and ZM Quant openly describing their wash trading methodologies and offering to fabricate volume on demand. CLS Global used 30 wallets to execute 740 wash trades that accounted for 98% of the FBI token's total reported volume. Now, that number deserves emphasis because it reveals the industrial reality beneath the surface of crypto exchange data. Gotbit's founder pleaded guilty to wire fraud and conspiracy, receiving 8 months in federal prison, while the firm forfeited approximately $23 million in seized cryptocurrency and ceased all operations permanently. But the landmark prosecution establishing the criminal boundary arrived with SafeMoon. SafeMoon's CEO was convicted on 3 felony counts and sentenced to 100 months in federal prison, the equivalent of spending most of a decade behind bars. The court explicitly rejected the defense that this constituted innovation gone wrong, categorizing the conduct as criminal theft after prosecutors proved that executives secretly retained access to liquidity pools they publicly claimed were locked. The critical legal development enabling these prosecutions is the DOJ's strategic decision to charge market manipulation under wire fraud statutes rather than securities fraud. This completely bypasses the question of whether a token constitutes a security under the Howey test, meaning the manipulation playbook described throughout this video is potentially criminal regardless of how many individual tokens is ultimately classified by regulators. Every token, whether labeled a utility, a governance asset, or a digital commodity, falls within the reach of federal wire fraud prosecution if deception is used to infiltrate or inflate its value or fabricate its demand. The structural reality confronting every retail participant in the current cycle is not a temporary market inefficiency waiting to be corrected. It is an engineered extraction system where low float launches create artificial scarcity, coordinated hype campaigns manufacture the demand window, vesting cliffs release insider supply into the manufactured demand, An OTC infrastructure allows the most sophisticated actors to exit before any of this becomes visible on-chain. And until regulatory frameworks develop the enforcement capacity to match the speed and sophistication of these mechanics, or until the market collectively refuses to provide exit liquidity at inflated valuations, every capital deployment into a newly launched token requires a fundamental understanding of who is on the other side of that trade and what their exit timeline looks like. So, will the ongoing wave of federal prosecutions and the expansion of frameworks like MiCA finally impose meaningful consequences on manipulative token structures? Or will the next generation of launches simply engineer more sophisticated obfuscation to stay one step ahead of enforcement? Let me know your assessment of the structural crisis in the comments down below. And if you want to understand exactly how stablecoin regulatory frameworks are reshaping the broader crypto infrastructure, well, you could check out our deep dive on that video right over here. Thank you all so much for watching, and I'll see you again very soon. It's Lewis, signing off.